What is going on, investors? Hopefully, guys are doing well out there. Welcome back to earnings season. And this time around, we're going to take a look at the banking sector. All of these companies that we'll talk about on today's show, we'll talk about JP Morgan, we'll talk about Bank of America, and we'll talk about Wells Fargo as well. Because when you come over here to the XLF ETF, these are the number one holdings outside of Berkshire Hathaway, which we'll talk about in a couple of weeks when that company reports their earnings. Now, today's show will be very similar to our Friday FANG Stock Recap show. Basically, what I'm going to do is run down essentially a quarter's worth of news for each of these companies. We'll take a look at some of the most important headlines. We'll take a look at some of the interesting things that are happening with each of these companies. We'll also give you a preview on Friday's earnings. Again, all three of these companies report their earnings on Friday. We'll take a look at the revenue estimates, some of the earnings estimates, and then finally, towards the back half of the show, we'll take a look at this all from a technical perspective. We'll look at the XLF ETF, and we'll look at each individual stock as well from a technical perspective. There are timestamps down below if you want to jump around to the stocks that interest you the most. Full disclosure, I own shares of JP Morgan and Bank of America and a couple of shares of the XLF ETF as well. I've been in and out of Wells Fargo over the years. Let's kick things off with JP Morgan, ticker symbol JPM. Over the last year, down just 16%. Not too bad. Over the last 6 months, this thing has been in rally mode, up 23% in terms of its earnings, which are expected to come out on Friday. We're expecting revenue to come in right about $34 billion. To be honest with you, the next couple of quarters over at JPM actually looks really nice. You're looking at kind of mid-teens growth on that earnings side, getting up to $35 billion worth of revenue. Then it should stall out a little bit for the next couple of quarters, the next year or so. From an earnings standpoint, we're actually expecting earnings to contract a little bit in the most recent quarter. About $3.12 per earnings, but it should reaccelerate over the next couple of quarters, and then similar to revenue, kind of flatten out to kind of a single-digit growth rate. Now, in terms of what analysts have adjusted their revenues, so earnings revisions been a big topic over at Wall Street over the last year or so, as many believe that earnings revisions need to keep coming down. Well, bank's a little bit different story. We've got those rising interest rates, so they're actually pumping out a little bit more revenue, a little bit more earnings than maybe was expected. And so we're seeing over the last month and even over the last 6 months over at JP Morgan, nobody's really walking in these revenue estimates. And I tell you what, if you're walking into some major recession or depression, like maybe a Dr. Doom is trying to predict, well, JP Morgan's revenue estimates and even their earnings estimates not really projecting that. In fact, over the last 6 months, analysts have actually been pumping up their targets on that EPS side for JP Morgan. Now, BlackRock, JP Morgan, 11 other financial institutions are landing on Kentucky's bad list of energy boycotters. We're seeing similar things in other conservative states here in the United States, Texas, among others. Many of these states actually generate a lot of money through the oil and gas industry. So in some sense, it actually makes sense what these states are doing. What they're trying to do is get JP Morgan, BlackRock to get off this kind of ESG kick where they're not investing and not loaning money to traditional oil and gas firms. The way they're going to do that is Kentucky is going to pull their pensions and pull the other assets that they have invested primarily in BlackRock, but probably JP Morgan as well, maybe in a threat to get these banks to maybe create some carve-outs for ESG or soften the rules a little bit. Doesn't look like that's happening anytime soon. What this ultimately probably does is create opportunities for other banks out there that aren't going to comply or push forward these ESG type things. Looks like JP Morgan, BlackRock, they're going full woke and they're going to go full bore on these types of things. Other headlines as it relates to this, JP Morgan set climate targets for iron and steel, aviation, and cement investments. So if they're going to invest in your business in terms of these sectors, you need to be net zero emissions by 2050. My guess is the way technology is moving, most of these innovations and most of these types of things were going to happen naturally. You've got JP Morgan kind of pushing the envelope from a financing perspective, though. JP Morgan reportedly closed on an $800 million acquisition of Viva Wallet. That would be a 48.5% stake in the company, $800 million investment in the company. This company, Viva Wallet, serves small and medium-sized businesses in 23 different countries, focusing primarily like on merchant processing, merchant cash advance, bill pays, virtual debit cards, things like that. Now, the all-important delinquency rates on those all-important credit cards that people have. JP Morgan Chase reported this was back in December. Delinquency rates started to stabilize in November as the charge-offs started to rise. Here's the actual data. We've got JP Morgan here. This far right-hand column is where we were before kind of this whole pandemic thing started. So basically February 2020, you had a delinquency rate at JP Morgan at 1.17%. This is on all the credit cards. And you had a charge-off rate of 2.2. So what you are seeing is the far left-hand column is the most recent data that we have. Still very, very low delinquency rates at 0.73, charge-off rates ticking up to 1.64. You are seeing the trend start to tick up on those charge-offs from 1.1 up to 1.6, and even on the delinquency rates ticking up a little bit. But the thing to keep in mind is we're not even anywhere near where we were back before the pandemic started. So the companies and the banks have a little more room to go on that. JP Morgan declared a $1 dividend. It was a forward yield of 2.9%. The stock has rallied a little bit more, but you're roughly at about a 3% dividend yield over at JP Morgan. Morgan Stanley double upgraded JP Morgan earlier in December, talking about how they have operating leverage. That's just a fancy word by saying that your revenues are expected to keep outpacing expenses. In other words, JP Morgan will generate more revenue, have less expenses, and generate more profits. JP Morgan registers a trademark for a cryptocurrency wallet. This is a very interesting series of headlines. So this was back in November. The company registered JP Morgan Wallet as a trademark, as something that could include services like virtual currency exchange, virtual checking account, and crypto payment processing. But just a couple of weeks later, Jamie Dimon says crypto is a complete sideshow. But you actually have to parse Jamie Dimon's statement on this. He says that doesn't mean that blockchain is not real. That doesn't mean smart contracts won't be real or Web 3.0, but cryptocurrencies that don't do anything, I don't understand why people spend their time. So really is what he's talking about, those S coins or those really altcoins that actually really don't do anything. And I actually kind of tend to agree with Jamie Dimon, but it's possible that he actually is a little bit more bullish on at least blockchain and some of the benefits of cryptocurrency, as his bank behind the scenes are preparing for maybe some kind of cryptocurrency wallet in the future. Now, JP Morgan plans and pilots a rent payment platform for landlords. This also goes in tandem with the following headline, where JP Morgan and Haven Realty Capital start a joint venture to develop build-to-rent homes. What it appears is what's going to be happening here is because homes are so expensive, interest rates have ticked up. There's obviously, everybody needs a place to live, but not everybody can afford to buy a home. You have builders that want to continue to build homes, whether people are buying them or not. So JP Morgan also wants to continue to finance those operations since they're largely very profitable. So they start a joint venture where they're going to build these homes and essentially start renting them out. And on top of that, they're going to build their own platform to collect these rent payments. This looks like a business that JP Morgan could get deeper and deeper into. We'll look at JP Morgan from a technical perspective towards the end of the show, but we're going to move on to Bank of America, ticker symbol BAC. Over the last year, stock's down about 28%, but over the last 6 months, rallied a little bit, up about 9%. Now, in terms of the earnings estimates that we've got with Bank of America, again, all of these companies reporting their earnings on Friday. Bank of America tuning in at about $24 billion worth of revenue for the next couple of quarters. Looks very similar to JP Morgan. You're looking at double digit, kind of low double digit, almost low teens growth on that revenue side. Then it's going to flatten out as we look into the back half of the year and into next year. From a earnings standpoint, very similar to JP Morgan as well. We're going to go negative on that EPS side, but then it's going to magically reaccelerate over the next couple of quarters, which makes a little bit of sense as those interest rates tick up. It actually takes a little while for that book of business to start generating maybe larger earnings and larger profits. All of these banks have been going through different types of cost cuttings and efficiencies, and those things take a little while to start playing out. This is why my take has been for many, many months now that the second half of this year, 2023, actually is going to look really good from an earnings standpoint. Whether or not it gets priced into the stock market now or later certainly remains to be seen. But those earnings for a lot of companies, I think, is going to look really good towards the back half of next year. Now, in terms of revenue estimates, looks like to me with Bank of America, the analysts really pulled them in many, many months ago and have been maintaining those revenue estimates for the company over the last couple of months. From the earnings side, very similar type of thing. The analysts were very quick to pull back on their EPS estimates. This was about 6 months ago, but over the last month or so, not so much. Now, Bank of America also has a lot of exposure to that credit card industry, just like JP Morgan as well. We are seeing those delinquency rates continue to creep up, but similar to JP Morgan, we're still off considerably where we were back in February 2020, or essentially in 2019. You see your delinquency rate over at Bank of America was 1.63%. Your charge-off was at 2.6. The most recent read on delinquencies was about 1%, and charge-offs just 1.3%. That is maintaining relatively steady at Bank of America on both measures, and again, well below where we were back in 2019, early 2020. The housing market may have 2 more years of pain, according to Bank of America's CEO. That certainly will impact the next company that we talk about when it comes to Wells Fargo. They have a very large mortgage business. Overall, Moynihan, who's the CEO of Bank of America, says he's preparing for a brief and mild recession in 2023. You have to ask yourself, if he's correct about that, is that priced into the stocks or most stocks? I would say probably not. Now, Bank of America downgraded to neutral as rates already priced in. What this analyst is saying is the stock has already kind of ran up to factor in a little bit higher interest rates. And keep in mind, higher interest rates are good for all of these banks. But what it also does is it pulls back people's willingness and ability to actually borrow the money at that rate. So it's kind of a catch-22. Yes, you make a little bit more money on the loans that you service, but less people are going to be knocking at your door to borrow that money. Now, Bank of America declared a 22-cent dividend. The company has about a 2.5% yield. It does grow, and they do have buybacks on top of this as well. When we come over and look at the technical chart of Bank of America, it is pretty much a thing of beauty. Now, moving over to our last company that we'll talk about is Wells Fargo Company, WFC. Over the last year, company's down 20%. Year to date, up 3%. The figure I was looking for was actually the 6-month figure, up about 8%, very similar to Bank of America. Now, in terms of those revenues that are expected to come out on Friday for Wells Fargo, we're looking at about $20 billion. That would actually be a decline year over year. Like the 2 other banks that we've talked about on today's show, you're actually going to go to double-digit revenue growth for the next couple of quarters and then kind of soften out to very flattish growth. Wells Fargo has its own problems when it comes to revenue and its book of business. We'll talk about that related to some headlines that have come across more recently. From an earnings side, you also expect it to go negative to $1.22 per share in the most recent quarter. It should accelerate for the next couple of quarters. Again, is this priced into the stock? Is the average investor expecting this type of growth over the next couple of quarters based on where the stock market is trading today? Given where the bank stocks are, maybe, but some of these other sectors, I'm seeing very similar type of things set up. This is why I've been bullish on the second half of 2023. Now, in terms of analyst estimates, been pretty steady over the past couple of months for Wells Fargo, both on the earnings side and on the revenue side. A little bit more pullback on that earnings side, and some of it has to do with some of these headlines that have crossed for Wells Fargo as they are inching closer to an asset cap liftoff with a $3.7 billion settlement. This all relates to the account scandals that Wells Fargo was involved in several years ago. They've turned over their management, and I would argue they've kind of largely moved past this, but they still have to shore up all these types of things with the federal government. This actually only resolves 3 of the consent orders out of the bank's 9 total. So a $3.7 billion settlement is only for a third of the problems that the bank faces. This is not directly related to the Federal Reserve's $1.95 trillion asset cap placed on the bank. So I don't know if a lot of investors realize this, and this is one of the reasons why I'm currently out of Wells Fargo, is the Federal Reserve is not allowing Wells Fargo to get above $1.95 trillion in assets based on, again, the problems that they had creating accounts for customers and all those types of things. This will eventually get lifted. The price of the stock will move, I think, before it actually gets lifted. I think we're kind of seeing some evidence of that already with Wells Fargo, but you're essentially capping the business at $1.95 trillion. This is why when you see headlines that the company is cutting certain segments of the business, sometimes over at Wells Fargo, it's actually related to the fact that they have to keep their business under a certain level in order to meet the Federal Reserve's regulations. Now, the settlement doesn't mean Wells Fargo is past its issues, according to CFPB's Chopra. They are waving a heavy hand over at Wells Fargo, I tell you what. And the $3.7 billion settlement that we talked about in the previous headline was larger. I saw estimates for like maybe $1 billion, maybe $2 billion. So they are waving a heavy hand, and Wells Fargo's basically having to take it on the chin. Now, Wells Fargo cuts hundreds of jobs in their mortgage business amid rising rates. So the company continues to pull back on one of its larger businesses, one of its more profitable business. The company is also, what they're also doing is obviously having seen revenues come in. When the mortgage rates go up, they obviously lose a little bit of a business there. In January of last year, the bank identified more than $8 billion of potential savings that will take in over the next 3 to 4 years. That's certainly something that we'll look for when we look at the earnings on Friday. Now, one way to invest in these companies is obviously through an ETF. One of the most liquid and the most popular and the one that's most well covered is the XLF ETF. And when you take a look, there's a reason why here on the channel we talk about JP Morgan, we talk about Bank of America, we talk about Wells Fargo, and we often do a Berkshire Hathaway as well, which typically reports like on a Saturday or a Sunday. When you look at the weighting of those 4 companies, you are looking at like 35% of the index. And then it's rounded out by Charles Schwab, a great bank and broker if you need one. You got Goldman Sachs, Morgan Stanley. Look, we got nothing against the rest in this group, but the XLF ETF really weights these kind of consumer-facing banks and Berkshire Hathaway. And when we come over here and look at this from a technical perspective, I got the XLF chart here. This is on a weekly platform. What we're seeing is really, for the past decade and a half, you've been on a monster. We're talking about a monster bull run. More in the shorter term, this is what we want to see with the rest of the stock market. Okay, the rest of the stock market hasn't done. We'll take away that green line. And in fact, we'll slide this chart over here. This is where the most of the stock market is. It's been sliding since January or even November of last year in a channel. What we're looking for is a breakout to the upside, and that's actually what the financial sector is doing. And maybe the financial sector will lead the rest of the stock market out. Now, what this has me believing is that potentially the lows for the financial sector were back here in September, and maybe even the stock market back in September and October. And now you're starting kind of a new wave of an uptrend. Doesn't mean you won't come back down here, maybe come close to retesting these, come and do some kind of back test to the top of the channel. That is certainly possible and maybe even probable from a technical perspective, but this is exactly what we're looking for with the S&P 500, all the tech stocks, any of the speculative stocks that you've been watching that have been in this downward channel. You're looking for a big kind of weekly or monthly candle to bust you out and then maybe followed by a second one. This looks beautiful from a technical perspective. This is something you can buy the dip on. We'll certainly keep an eye on that if these banks kind of swing and a miss later this week. Now, JP Morgan is in its own little technical pattern. Again, very similar to the broader markets and most stocks that we've been following here on the channel. JP Morgan was in a very steep downward channel, but eventually these stocks will break out, and look how quick they break out. Again, I'm on a weekly chart here. This is why I'm not waiting for Jerome Powell to tell me to buy stocks. I'm not waiting for some guy on CNBC to tell me to buy stocks, because again, each one of these bars is a week. Look at JP Morgan. It was down here in October at about $100 per share, and then 1, 2, 3, 4 weeks later, it rallied 30%. Jerome Powell didn't tell you to buy stocks. Certainly nobody on CNBC is telling you to buy stocks. This stock rallied 30%. Now, it is at a key resistance level. This green line has been really on this stock since we've started the channel. About 138. It was some previous highs that we made back here December, January of 2020 before the massive drop in March. Would make sense actually for JP Morgan to take a little bit of a breath here, probably maybe on earnings. Again, even if you could have a pretty massive retracement on this stock and you're still kind of setting up some kind of reversal pattern here. This looks really good. Now, we're talking about extraordinarily bullish would be some kind of bullish news and bullish trade on Friday for JP Morgan, and you pop pretty solidly, probably up into the low 140s. That would all but confirm that these were the lows for likely the entire market back here in October of 2022. Now, moving over to Bank of America, very similar type thing. When you look at the XLF, you look at Bank of America, very similar type of formation since 2011. So we're going on well over a decade now. The stock has been in just a steady bull run. Now, unlike JP Morgan, you're not really at a key resistance level. This is actually setting up very nicely. You've got a series that's not convincing, but you've got a pretty convincing series of higher lows here. You're also confirming this with some higher highs more recently. This one looks like to me with some decent results should come back up here. Retest. You've got some resistance up here at about 38. You should retest this $38-40 range as long as the momentum stays in this stock. Should meet some resistance there and then pull back. Any pullback south of really where the stock is right now. So I wouldn't blame anybody if you're looking to add to your Bank of America. It complicates the situation. I would never recommend somebody kind of jumping in when we're just 4 days away from earnings. I'd rather wait for the confirmation that the earnings were good. Maybe it pops up here, wouldn't chase it. Eventually you'll get some kind of pullback. You buy the dip. There's always that risk that these banks have some kind of surprise and then all of a sudden this trend that we've been on has broken. But I tell you what, we have been on a decade-long trend here, so it would take some serious news to break that with Bank of America. This looks really good from a technical perspective. The XLX looks pretty good. So does JP Morgan. Now, Wells Fargo's kind of, again, in its own little group because they've got that asset cap. They've had those troubles with the bank. They probably lost a little bit of consumers due to that thing. This thing has been in a trading range. Okay, you have kind of an upper trading range from 43 up to about 60. That's where I would actually think about selling this one, and that's where we're at with Wells Fargo. So I tell you what, if this one rallies after earnings and you move up here into $45-50 range, this is probably where I take some profits. Maybe not on a whole position, but I've already actually done this. I've already taken profits on Wells Fargo. Now, if you break down below, there's a trading range on the really low end down here to 23 up to 36. Probably more specifically, you're looking at something like this from about 30 to 35 on this one. This is where you could accumulate a little bit of Wells Fargo. But again, keep in mind, when you're looking at the XLF ETF, it is in fourth place. It's not much greater than Charles Schwab, not much greater than Goldman Sachs or Morgan Stanley. The true standouts of this group is Berkshire, which again, we'll talk about when they report their earnings in several weeks, and then JP Morgan as well, and then Bank of America just shortly behind that. That was the financial sector preview show. We should have those earnings on Friday. I might not get to all of the banks on Friday, but we'll carry over the ones that we miss into the weekend because we've also got our Fang Stock Recap show on Friday as well. Hopefully, guys, have a great day out there. Buckle up for earnings season. We'll be here to cover it all for you. Until then, good luck with your investments.